investing has changed a lot in the last few years, right? Tech, fintech, new asset classes. What's one big trend in investing right now that you think young investors should pay attention to?
Okay, so a lot of trends are happening and they are much more expert than us to catch those trends, because we are into personal finance and we understand that investment is boring. We treat it like that and we are there in the long game. But them, they are youngsters and they are fresh, their mind, and lot of things they are catching up. They are tech savvy. So I personally know people who are in their early 20s just passing out from college. They understand that how algos work. They understand that how FNOs work. They will write strategies and follow those strategies and make money. So if I tell them that this is what is happening and you must follow that, so I will sound preachy. So in the beginning, in the podcast, I don't want to sound preachy. So for them, I should say that there is one core trend that never fails. So you have to follow that trend, and the trends that are going on, if you are following those, well and good. If you are making money via even FNOs or even algos, that is fine, do that, but don't put your or all your eggs in one basket. You need to understand that you need to set aside some amount of money for the long game, in mutual funds, doing SIPs. Then only you will understand the impact of compounding. So these people, they catch the trend that are going on, but they don't understand the concept of compounding. They do, but until you realize it, until you live it, you would not understand what it is. So in the beginning, if you, from the very beginning, from early 20s, if you have been investing some amount of money in mutual funds, then in 4 or 5 years you'll realize what has happened. So this is the core trend that people must focus on.
Very interesting. The operative word being if you make money in F&O. Right? Okay, so you've spent years breaking down personal finance into real world relatable advice. Was there a moment or experience that made you realize that investing needs to be tied to life goals
Correct.
rather than just chasing returns?
Correct, truly. So even when I was unmarried in my 20s, then when I would sit down and think about my life goals, then I wouldn't come up with much any goals. I'm not a materialistic person, so I don't want to buy a new phone or gadget. That was never in my mind. Then what to do? Then obviously I only focused on wealth creation, something that retirement has to happen. So I started doing it that way. I did not chase returns in that sense. But linking goals with investment is very important. Again, I'll share my personal experience. So, okay, in the beginning, I did not have any goal. Then I got married, and then husband and I decided to buy a house. Now we'll need money for that. Some down payment amount we'll require. Now my husband is also a stock market journalist, and he is 100% equities. Then I had to make that balance. So I would invest in equity mutual funds, but I would also set aside some money in FDs and debt, so that we have that balancing asset allocation between us. So that happened. So down payment is extra. Very recently we bought a home, and that happened fantastically. We could manage, and his amount of money obviously had better returns. Then we had that wealth amount in it, and with me came that stability. I had liquid amount of money, so whatever initial money we had to deploy, I could do that. But we still had some time to make the final payment. So wealth creation happened with his money. So that way it was quite well. But where we failed was that then you would also need money to construct home, then interiors, all those things. So we had no money linked to that. We had money in stock market, but nothing as such liquid linked to that. Now stock markets are falling. So and our work is going on. So we are really troubled about it, that how do we manage it? We are managing it. We don't want to sell our stocks because we know that it will again go up. So that is my message for all, that I have lived it personally. Unless you are linking your goals with maybe a mutual fund scheme or with stocks, unless you are doing that, you won't be able to achieve that. You can't rely on stock market returns. It can go any time down, and you need money maybe after a week. And then suddenly COVID happens, then what?
Yeah.
So you need to have that goal set, and when that goal is maybe 5 or 6 months away, or even a year away, in case of child education, I should say that if it's a year away, then you need to take out that money from the stock market and keep it liquid with you. Then only the element of wealth creation plus returns will happen.
Let's take your example and apply it to everybody else also, right? Like when you said that you didn't really think of milestone investing, goal-based investing. See, that's the point, right? milestone in investing sounds great. Okay, but
Right.
let's be real, right? Most young people invest for wealth creation and not for goal-based investing.
Correct.
Okay,
Very true.
how do you make this concept work and not
Mhm.
just make it like a to-do list or something there?
Yeah, here what I feel is that we may have only two goals, long term and short term. Where you are attaching it, where you are linking it doesn't matter. Either you will have goals which are 5 years away, or you will have something 1 or 2 years away. So why not have just two baskets, long term and short term, and do it like that? No to do list. You are in touch with maybe any financial advisor, they'll tell you to list goals, then you will not have any. I did not have any in my 20s. Then what to do? To simply have two goals, long and short.
Very interesting.
Hmm.
Okay, so now let's look at someone who's in their 20s. Okay, first job, first apartment, first big trip, first car. Okay,
Hmm.
major life moments, all of them come with financial decisions.
Hmm.
Okay, so how should someone in their early 20s start planning, like actually planning for these milestones without
Right.
being overwhelmed?
So very simple. So the moment you start earning, you need to apply it. It sounds cliche. You need to apply that budgeting rule of 50, 20, 30. Sounds cliche, that is there, but that is the way to go about. These days what happen, usually people they live paycheck to paycheck. They will say YOLO, you only live once, then you have to maybe spend everything. But from the beginning itself, you need to have that mindset that yes, you are going to have your expenses. So 50% are for your expenses, then 20% you need to set aside as investment. At least 20% money you can save, and then you should deploy it somewhere. And the best way to deploy it, start with simply Nifty Index Fund. So that 20% money, your salary that you are getting, you need to invest. And the simplest way to start investing, your first investment could be Nifty Index Fund. Then talking about that 30% is your want. Either you can spend it, YOLO. You want something to spend, you want expensive clothes, expensive gadget, iPhone, etc. So that 30% amount you can keep saving, and that's how you can approach it. But you and then people who may want to decrease their want and maybe setting aside more money in investment side of it, then obviously that can be more than 20%. That's a personal choice. But this is how, if you're disciplined, if you have a disciplined mindset, then I believe you can make that balance. You can live your life and you can also get your wealth creation done simultaneously. So that is how I did it. That is how.
Mutual fund investments are subject to market risk. Read all scheme related documents carefully.